Imagine walking into a job interview and being asked, "What's a balance sheet?" Or sitting across the table from your crush and them asking, "So what do you do?" And you being prepared. Or maybe you're just looking to get smarter. Whatever your reason, stick around. We're about to unlock the secrets of one of the most important financial documents out there. Now, most people hear the words balance sheet and immediately think it's too complicated. But the truth is, a balance sheet is simply a financial picture of what a company owns, what it owes, and what's left over. In this video, I'm going to walk you through balance sheets step by step, using simple examples, clear explanations, and real-world connections. By the end, you'll be able to look at any company's balance sheet and actually understand what it means. Now let's dive right into it. What is a balance sheet? A balance sheet is one of the three main financial statements every business uses, alongside the income statement and cash flow statement. While the income statement shows how much money a company makes or loses, and the cash flow statement shows how money moves in and out, the balance sheet shows a snapshot of a company's financial position at a single point in time. Think of it like taking a photo of someone's wallet. It shows what's inside at that exact moment. The basic formula. The entire balance sheet is built on one simple formula: assets, liabilities plus equity. This formula means that everything a company owns, assets, is either financed by debt, liabilities, or by the money of its owners, equity. If you remember only this formula, you've already understood the foundation of a balance sheet. Breaking down, assets are everything the company owns or controls that has value. Assets are split into two types: current assets and non-current assets. Current assets are things like cash, accounts receivable, or inventory, things that can be turned into cash within a year. Non-current assets are long-term items like property, equipment, or patents. For example, if a company has $50,000 in cash, $30,000 in inventory, and a factory worth $200,000, those are all assets. Understanding liabilities. Liabilities are the opposite, what the company owes. Just like assets, liabilities are divided into current and non-current. Current liabilities include things like accounts payable, wages payable, or short-term loans. Non-current liabilities are longer term, like a 10-year bank loan or bonds issued by the company. If the company borrowed $100,000 from a bank, that's a liability. Equity explained. Equity is the leftover portion after liabilities are subtracted from assets. It represents the value that belongs to the owners or shareholders. Thanks for watching. Remember, understanding finance isn't just about money, it's about power. The more you learn, the more you can achieve. See you next time.